Good morning and welcome to the quarterly banking profile for second quarter 2025. FDIC Acting Chairman Travis Hill is joined today by Andy Felton, Director of our Division of Insurance and Research. We'll begin with an overview of the quarterly results and then turn to your questions. Mr. Chairman.
Well, thanks, Amy. So I'm going to offer a few brief comments on the results, and then I'll turn it over to Andy, who can walk through the charts in more detail. The first thing I want to highlight is that the DIF's reserve ratio has now passed 1.35%, which is the statutory minimum. As people may recall, the reserve ratio fell below 1.35% in 2020 during COVID, following the huge increase at the time in deposits into the system. We had 8 years for the reserve ratio to cross back over 1.35%, and so it has now crossed 3 years before the statutory minimum or the statutory deadline, which means also that we are no longer in a restoration plan. Overall, this was a very strong quarter. Net income declined slightly, but that was entirely driven by the Capital One Discover merger. If we exclude the increase in provision expense related to the merger, return on assets would have increased from 1.16% to 1.23%. So a very solid quarter. Loan growth improved. It's the first quarterly increase or the highest quarterly increase in several years, after a number of quarters of tepid loan growth. Asset quality remains favorable. Past due non-accrual decreased, remains below the pre-pandemic average, and provisions would have been down but for the Capital One Discover merger. So those are a few highlights, and I'll turn to Andy to walk through the presentation in more detail.
Thank you, Acting Chairman Hill. I'll now walk you through some selected charts from the FDIC statement to highlight some of the results from this quarter. I'm not going to cover all the charts in the statement, but we can cover any of the others if you have any questions. This first chart shows that the banking industry reported quarterly net income of $69.9 billion, a decrease of $677 million, or 1% from the prior quarter. As the Acting Chairman mentioned, this quarterly decrease in net income was due to an increase in provision expenses related to a large bank acquisition. The banking industry reported an ROA ratio of 1.13% in second quarter 2025, down 3 basis points from 1 quarter earlier, and down 6 basis points from 1 year earlier. The next chart shows the breakdown of the changes in the industry's net income quarter over quarter. The primary driver of the industry's $677 million decrease in net income was higher provision expense, which increased $7.6 billion, or 33.7%. As mentioned, this was largely attributable to Capital One's acquisition of Discover Financial Services, because accounting standards require the acquiring institution to recognize a provision expense related to certain acquired assets. Absent this large provision expense, net income would have increased due to higher net interest and non-interest income. This chart shows the average net interest margin, or NIM, for the industry and for 5 asset size cohorts. The industry's NIM was relatively flat, up 1 basis point from the prior quarter to 3.26%, which is above the pre-pandemic average of 3.25%. This next chart shows the quarter-over-quarter changes in the industry's average yield on earning assets and average cost of funds. During the quarter, the cost of funds decreased 1 basis point, while the yield on earning assets remained unchanged. I'm going to move through those, move to this chart, which shows the level of unrealized losses on held-to-maturity and available-for-sale securities portfolios. Total unrealized losses of $395 billion decreased $17.9 billion, or 4.3%, from the prior quarter as low-yielding securities continued to roll off the balance sheet. The next chart shows the change in loan balances on a quarterly and annual basis. The industry's total loans increased by $263.7 billion, or 2.1%, in the second quarter. Loans to non-depository financial institutions, or NDFIs, and loans to purchase or carry securities, including margin loans, had the largest dollar increase among loan types reported, though some of this increase was due to continued reclassifications following the finalization of changes to the call report to how certain loan products are reported. In addition, credit cards, non-farm, non-residential commercial real estate, and 1 to 4 family residential loans also contributed to the industry's quarterly loan growth. This next chart shows that asset quality metrics for the industry remained generally favorable, though weaknesses in certain portfolios persisted. The overall past due and non-accrual rate fell 9 basis points from the prior quarter to 1.50%, below the pre-pandemic average of 1.94%. While banks reported quarterly decreases in most portfolios, the PD&A rate for non-owner occupied CRE, multifamily CRE, and credit card portfolios remain well above their pre-pandemic averages. Looking deeper into the CRE portfolio, this chart shows that elevated PD&A rates of non-owner occupied property loans persisted in the second quarter, driven by the portfolios of the larger institutions. Banks with greater than $250 billion in assets reported a non-owner occupied CRE PD&A rate of 4.33%, down from the recent peak of 4.99% in the third quarter of 2024, but well above the pre-pandemic average rate of 0.59%. However, these large banks have lower concentrations of such loans in relation to total assets and capital than smaller banks do, mitigating the overall risk. Overall, the industry's volume of PD&A non-owner occupied CRE loans decreased $387 million, or 1.6% from the prior quarter. I'm going to skip this slide, move on to this next chart, which shows that domestic deposits increased for the fourth consecutive quarter, rising $101.5 billion, or 0.6% during the second quarter. Estimated uninsured domestic deposits increased $186.6 billion, offsetting a decline in insured domestic deposits of $87.3 billion, or 0.8% during the quarter. The industry's non-deposit liabilities increased by $193 billion from the prior quarter, driven by growth in reverse repurchase agreements. This chart shows the number of banks on the FDIC's problem bank list. Banks on this list have a Camel's composite rating of 4 or 5. The total number of banks on the list decreased by a net of 4 in the second quarter to 59 banks. The number of problem banks is 1.3% of total banks, which is in the middle of the normal range for non-crisis periods of roughly 1 to 2% of all banks. 4 banks opened during the second quarter and 1 failed. And finally, this chart shows that the Deposit Insurance Fund balance, or the DIF balance, was $145 billion on June 30th, 2025, up $4.4 billion from the first quarter. Assessment revenue continued to be the primary driver of the increase, adding $3.2 billion to the DIF balance. Interest earned on investment securities, negative provisions for insurance losses, and unrealized gains on securities also contributed a combined $1.9 billion to the fund, partially offset by operating expenses of $630 million. Insured deposits decreased by 0.8% during the second quarter, while year-over-year insured deposit growth was 0.6%. The reserve ratio increased by 5 basis points in the second quarter to 1.36% and was 15 basis points higher than a year earlier. As the acting chairman mentioned, the FDIC adopted a restoration plan on September 15th, 2020 to return the reserve ratio to the statutory minimum of 1.35% by September 30th, 2028, as required by law. As of June 30th, 2025, the reserve ratio exceeded the statutory minimum, and beginning with third quarter 2025, the FDIC will no longer be operating under a restoration plan. That concludes my presentation of selected highlights from the quarter, and we can now open it up for questions.
Thank you. We'll now take questions. If you're joining us virtually, please use the raise your hand feature and I'll call on you by name. Our first question will come from Ryan Tracy of Capital Account.
Thank you. Good morning, Mr. Chairman. You've been in on this board for 2 going on 3 years now. You've been a regulatory staffer for many years before that. There's something new in the atmosphere of these jobs right now, and that's that board members apparently can be removed. These boards are less bipartisan than they used to be. What's it like doing your job in that environment? How does it affect your ability to carry out the FDIC's mission?
Well, thanks for the question. I would say, look, from my perspective, the job is still the job. There are always changes in personnel, people coming and going. You know, it's not atypical that there are transitions when it comes to who's on the board. So from my perspective, it's, you know, the job is still the job, and wouldn't say that anything is significantly different about it.
Our next question is from Katanga Johnson at Bloomberg. Go ahead, Katanga.
Hi there. Thanks so much for hosting this today. I was just curious about overall the agency's supervision efforts, or how it oversees exams. I'm particularly looking at the problem bank list, and that often fluctuates. But how would you describe what's happened in the second quarter to get that number lower broadly?
Yeah, I think the problem bank list is generally consistent with what we've generally seen for non-crisis periods. You know, there were a number of banks that were added to the list, a number of banks that were taken off. There was a net decrease of 4, but I think overall it was fairly stable, with some banks coming in, some banks going off. Again, I think overall conditions are very favorable. It was a very strong quarter for the industry, and so don't think there's really anything too remarkable there.
Our next question is from Pete Schroeder at Reuters. Go ahead, Pete.
Hi, yeah, thanks so much for doing this. Wanted to follow up on Katanga's question on supervision and just ask more broadly how you're kind of thinking about that particular aspect of the job. There's been numerous comments made by some of your regulatory colleagues about the need to change supervision. Secretary Bessent has flagged it as well. I just wanted to get kind of maybe an update on where things stand with FDIC supervision. How are you thinking about approaching that, and kind of what efforts are being made to potentially change how you go about doing that?
Yeah, so reforming supervision is, I think, one of the big ticket agenda items for the next couple years. It's something I've talked about a couple of times in the past. We have a number of work streams underway to try to focus supervision more on material financial risks. I think in a lot of ways supervision has become too process focused. What that will mean in practice, as I said, there's a number of different work streams we have underway. There'll be more to come and more to announce there in the coming weeks and months. We've taken some steps already, things like proposing a new approach to supervisory appeals. But I think in terms of the on the ground, how we do supervision, that's something that is getting a lot of attention right now. And again, I think there'll be more to come in the near future on that.
Katanga, your hand is still raised. Did you have another question?
I do now. I was curious about, obviously early this year there was an announcement around the diff balance, and there's another update today. I wanted to take a step back and just ask Acting Chairman Hill whether he had a view on, given that the industry, and thanks to the industry, the fund is ahead of schedule in terms of the restoration balance. I mean, do you think there needs to be changes to deposit insurance? I know there had been previous conversations on this in terms of whether it should cover, a larger amount of deposits. But maybe there are other things that you think could happen regarding the fund in general. What's your view on deposit insurance and where it stands?
Yeah, so certainly there's been a lot of conversation about deposit insurance reform around fund management and other related topics. There've been a number of bills introduced in Congress. I think from our perspective, at least when it comes to deposit insurance reform, we've been engaged to the extent that Hill offices have asked for our feedback. We're not taking any formal positions on any specific pieces of legislation. but generally trying to be constructive, which is our typical approach if members of Congress have questions. I think otherwise, with respect to our own management of the fund, I think there's a lot of things that we continue to consider, but don't have any announcements to make right now.
Our next question is from David Hollerith at Yahoo Finance. Go ahead, David.
Hi, Acting Chairman Hill. Thank you for doing the call. I wanted to ask about the quarter's loan growth. I think last quarter you guys described loan growth as tepid, and this quarter you're describing it as accelerating. Generally, I was just curious about what drove that growth during the quarter, and sort of the topic of how lending in general across the banking industry has been below pre-pandemic standards has kind of been a relevant one for a while. So just generally how you're thinking about that moving forward. Thanks.
You want to take that?
Sure. Thank you. The largest single contributor of loan categories to the growth this quarter was, as I mentioned, the loans to non-depository financial institutions, or NDFIs. That's been the fastest growing category since the 2008 great financial crisis, part of which is due to some changes in how we ask the banks to categorize loans on the call report, and part of it is due to organic growth. And that's a story that has been covered pretty extensively. However, we've also seen this quarter increase in growth in credit cards, in commercial real estate, and in 1 to 4 family residential loans. So I would say it was a pretty broad-based growth across the different types of loan portfolios.
Thanks. Just to follow up on that, on the NDFIs lending, any idea about when that will be officially reclassified? There won't be sort of that question about whether or not there's loan growth, or it's more of just a filing change?
We think that that's mostly complete at this point. We are always working with banks to. There are always a lot of questions about how you have to interpret and slot different types of loans, but we made some changes to the call report a couple of quarters ago. They had a couple of quarters to, on a sort of best efforts basis, to adhere to those new instructions, and as of this quarter, that should be mostly final.
Got it. Thanks.
Katanga Johnson at Bloomberg. Go ahead.
That was an oversight. Pardon me.
Oh, we'll turn to Ryan Tracy at Capital Account.
Thanks for another opportunity. What's at the top of your regulatory agenda for the fall?
So we have a pretty busy agenda. The first thing I'll mention is Genius Act implementation. So the regulators have a long list of tasks to complete. So I think that will be at the top of the list, given that it's mandated by statute. We also have some recommendations related to digital assets coming out of the president's report that we're taking a close look at. I mentioned earlier reforms to supervision. As I said, there's a number of work streams there. With respect to capital, Vice Chair Bowman has talked about wanting to implement the International Basel Agreement either by the end of this year or early next year, which we're prepared to meet. So I think there will be a lot of work going into that in the fall. We have a number of proposals from earlier this year, the ESLR one, for example, that I think there'll be an effort to finalize. With respect to applications, we're looking pretty closely at potential changes to our bank merger statement of policy, our approach to de novos. We had a proposal related to branch applications. We are continuing to work on improvements to our resolution and resolution planning functions. So I think those are a few of the highlights, but definitely a busy agenda for the fall and the winter.
Did we have any other questions for the acting chairman or Director Felton? Sure. Go ahead. Ryan.
You mentioned the Genius Act. What is the FDIC's to-do list there? What's the? I know OCC is going to create the regulatory regime for issuers, I think, right?
So there are, depending on the type of issuer, who the primary regulator are will vary. There are several different potential federal stablecoin regulators. So depending on who the issuer is, it could be the OCC, the Fed, the FDIC, or the NCUA. I think it's fair to say that the OCC has the longest list of tasks, given its role of overseeing non-bank stablecoin issuers. But the FDIC also will have a role in overseeing stablecoin issuers too. And then there are some specific tasks specifically to the FDIC, and then there are some other things for the certification committee that we'll be a member of.
We have time for one more question. Seeing none, we will conclude our press briefing. If you have additional questions, please reach out to our Office of Communications at mediarequests@fdic.gov. And thank you for joining us today.
Thanks, everyone.